This was a fantastic month, and especially to my supervisors. It wouldn't have been possible to get to this point of the work without them, so thank you very much. As the title says, I'm going to talk about optimal leverage in high-frequency trading data. Well, this is an overview of my talk. First, I want to start with some objectives and motivation on why do we want to study this optimal leverage in high-frequency trading. Basically, what we want to do is apply the ergodicity economics project concepts to shorter timescales or high-frequency domains, basically. And this is important because this is a different approach from classic economic theory, and where classic economic theory approach says that randomness involves ad hoc effects of economic information coming into and modifying the prices and generating volatility. And this can hardly apply over short timescales, basically. So what we're going to show is that there is some structure in the statistics of the prices of some assets in a given market, and these are well predicted by the ergodicity economics project without taking into consideration the new information that might or might not get into your prices. And this impacts economic theory a lot, as it implicates a brand new theory of noise, which is what I just said, and also makes it able to solve long-standing open problems such as the equity premium puzzle. We'll see more about this and some other applications. So what do I say when I say I want to extend the ergodicity economics concepts to predictions to shorter timescales? I'm not expecting you to understand this figure right now, but hopefully you will understand it very well after the talk. So basically, this is my reproduction of the results that are in the ergodicity economic lecture notes from Alex and Ole. And what we basically have there is a prediction of how would the noise be around an optimal leverage. I will define leverage in a minute, against data points, basically. The prediction is very well from weeks to years. Basically, this is a log-log scale. It overestimates a little bit in the weeks, and we'll maybe talk a little bit more about that. Maybe there's another effect, right? But what I basically wanted to do in this project, what I did, is to extend this prediction for shorter timescales. So I will add the points from the 3 minutes to, I think I have until 5-6 hours. So there's still a gap between days and weeks, but that depends on the amount of data you can get. So we'll see this graph later, but with the new information extended. So to set up the dynamics, it's a simple and pretty straightforward dynamic. So we'll have a money, basically, which we'll call X. It's the wealth or net wealth at some point. And we'll have one risky stock. We'll bet either or into like one risky stock that we will call S, and another riskless stock, which we'll call R. So the riskless stock will not have volatility. The leverage will be the fraction of the wealth that is invested in the risky stock. So in this bar graphs, we think as the amount of bars as the wealth that you have. So basically, my initial wealth is red plus blue, and if we leverage 0.7, we'll have 30% of my money put in the riskless asset and 70% of my money put in the stock, in the risky stock. For that, we will apply step by step the returns that come either from the data or from a simulation. In our case, it will come from the data. But one thing that's important is that we want to see how the evolution of the world is for a constant value of leverage. And this is not possible to do without rebalancing your portfolio where you allocate your money, because it may happen that the return of the stock is bigger than the return of the riskless asset, and then your blue money will increase more than your red money, even if your red money still increases. And that will make the leverage, in this case, 0.78. So after each time step, what we're going to do is say, okay, I'll have this amount of money, this new amount of money in this time step, but I will reallocate my position to have a constant leverage. So basically, I'm doing actions at every time step. In the other case, if the growth of the return of the riskless asset is bigger than the return of the stock, we'll have a lower leverage at that point, and when I rebalance with the same amount of money in this time step, I will get 0.7. Well, how are we going to model this situation? Basically, we'll use geometric Brownian motion, which says that the relative rate of change of my world is contributed by two parts. One deterministic part, which grows exponentially with drift mu, and one part that is random, that has a volatility. W is a Wiener process, basically. We'll say that the stock has a mu s and a sigma s, and the riskless asset will have a mu r, and sigma r is 0, so it won't have volatility. So the very first thing, I thank very much Laszlo for introducing the growth rates in his talk, so I don't have to explain too much. Basically, the classic approach, the classic economic theory approach to calculate what your expected return is to calculate the growth rate of your expected wealth, which is basically the growth rate of your expected wealth, which is mu. And in the ergodicity economics approach, you'll want to see actually what happens to your money over in a long time, and that's calculated as the limit of the long time limit, basically, which is the same as the expectation value outside of the log, basically, because it's an ergodic observable, which is mu minus sigma squared over 2. And this is what Laszlo also said or showed, is that mu can be bigger than 0, but even if that's the case, sigma squared over 2 can be bigger than mu, and you're ruined in the long term. So even for a positive expected return, you can get bankrupt. We'll see more about that in a minute. So putting everything together, we have XL is our wealth, and this is the equation of how it evolves. Basically, what we have is we put together the stock and the riskless asset into one equation of the dynamic, and we'll have again a geometric Brownian motion. Now the drift is mu r plus L mu e, and the volatility is L sigma s. So where mu is the excess return, which is mu s minus mu r. So in the framework of classic portfolio theory, we see that we have in this graph the drift against the volatility. We have a straight line that is the place where the best or the most efficient, in the classical terms, investments are, and we'll have two red points, which are the two possible investments that I may be able to do. So one has a volatility 0, which is this point here. I have a pointer, which is this point here, and the other one has volatility sigma s, which has mu r plus mu e, which is mu s, basically. But we have to notice, or it's interesting to notice, that in this dynamic, investing with a leverage in either one of those assets makes DL as moving along this line. So basically, what we're going to end up having is a one single Brownian motion that has volatility L sigma s, and that has a drift of mu r plus L mu e, basically. And when L is equals 1, we'll have only an investment on the risky stock. When L is equals 0, we'll have only an investment on a riskless asset, which might be leaving your money in the bank and collecting the interests. But we'll also have all the points in the middle, which is L from 0 to 1, and L bigger than 1, it's also possible, which would mean basically borrowing money and buy more stock, borrowing money from the bank and buy more stock, and L lower than 0 would mean short selling, which is like borrowing stock, selling them, and putting that money in the bank. A little bit more of equations for completitude. This is what we showed before. From the other slide, we can see that in this case, the expected return, the classic approach to what classic economics wants to maximize is mu r plus L mu e. And in the time average growth rate approach, the time average growth rate is this value. So maybe I can ask to the audience, like, which one of the two would you consider better to see where your wealth is going to end up after a long time or after some time? In classic economic theory approach, they would say, okay, we'll maximize this, but if you do that, like, you'll have an infinite leverage depending on the sign of mu e, but it's usually the risk stock has a better return. And and here's where classic economic theory adds a lot of ad hoc argumentations on why it is not good to basically leverage infinitely. And they start talking about like risk aversion, so psychology arguments, and say, okay, this is not actually true. People might be risk averse, which is ad hoc explanations. Where the actual truth is that it doesn't matter what your psychology is, like, you're going to end up bankrupt. So basically, the time average growth rate is penalized by the square of the leverage and by the square of the volatility. So the existence of volatility makes it you for almost surely, or with probability 1 in a long time be bankrupt with high enough, if you go to high enough or low enough leverage. And what also this time average growth rate approach allows us to do is to calculate an optimal value of the leverage. So this is what the classic approach doesn't allow us to do, and what the classic will say is, okay, everyone has their own optimal leverage. In the time average growth rate, we have one optimal leverage for everyone, which is mu e over sigma s squared. And we'll see more about that. So let mathematics and models aside for a minute, and let's look at what the data says. So we took 2 weeks of data, which is 60 hours of market activity. So it's a little bit less than 10 days of market activity, of Google, Amazon, and Apple from IEX, which is an exchange that doesn't allow, that was created after the 2008 crash, that doesn't allow the involvement of high-frequency traders by setting a minimum time of transaction time to 350 microseconds. So you cannot transact faster than that frequency. And what we're going to see here is how the wealth evolution, the evolution of the wealth goes. This is purely from data in time. This is our 60 hours of data, basically, for different leverages. So we'll have a big enough leverage, 70. We'll see how our wealth goes down and down, and ends up very bad. A low enough leverage that also shows the same. 14.19 is the optimal leverage as calculated by, I'll say how in a minute. And the leverage equals 1, which means like investing only on the stock price, which is Apple, basically. So this is a step, this is only data, there's no model here. Perfect. And we can do we can say, okay, we'll do this for many leverages, and we'll see what the distribution of my my final equity is against the leverage. And in particular, we're interested in the time average growth rate. So we'll calculate the log of this equity divided by the delta t that we have. In this case, is annualized. And we can see that this is purely from data. This is not model. So we can see that this is the parabola in terms of leverage that we said before. So we're going to either find the optimal leverage by finding the maximum of this parabola. This is one optimal leverage. Or we can also, what I did is to fit a parabola and find the maximum that way. So stochastic market efficiency is the argument, is basically two arguments. One is stability. So if there's one optimum leverage, what is that optimal leverage? That's for everyone. If it's higher than 1, then everyone would be better off borrowing money to invest in stocks. And if it's lower than 0, everyone would be better off short selling stocks. And that's not a stable situation. So there will not be a counterpart for that situation. So basically, it's a simple, straightforward stability argument that says that the optimal leverage has to be between 0 and 1. And there's also more argumentation that you can make to say, okay, the best possible place is optimal leverage equals to 1. This is a hypothesis that we want to test. Because optimal leverage close to 0 would mean everyone leaves their money in the bank, nobody does anything, economy or people's economy doesn't grow. And L equals 1 would be the best way to grow. And this has many applications, in particular a theory of noise, which is the most interesting one for me, because it's a kind of a theory of why there's noise in markets, basically. So what we say is, like, if there weren't noise in markets, then if prices would change smoothly at different rates, everyone would be better off to invest on infinite leverage on the faster growing asset. And that's clearly an unstable situation. So basically, noise is a requirement for stability, for having a stable market. I will skip the equity premium puzzle because I'm running out of time. Also, what the ergodicity economics shows is that maximizing the time average without taking delta t to infinity, so it's not without taking the limit, we get a prediction of how the standard deviation around the optimal leverage will be. So what we have here is basically the same way that we have. We can make time windows, so we can see the structure of this thing in different time windows. We will cut the data in unoverlapping time windows. And we will calculate for each time window the optimal leverage. We'll see the statistics of the optimal leverage. And we'll have something like this. So this is for time periods or time windows for 25 minutes, 50 minutes, 120, and 300. And this is an awesome graph because it already shows that the lower your delta t is, the higher the standard deviation. And also, an incredible thing is that we'll see that the average of the optimal leverage is also is very stable and close to 0. So we'll analyze these two situations. This is Apple. This is the graph that I extended from the third slide, basically. So we have this time window in minutes, and we see a prediction for the Apple stock market of the standard deviation of the optimal leverage as predicted by the time average growth rate. What we also saw is that there's a lot of variation at the initial days, and we can actually see where the changes in the day are in this graph. There's a lot of volatility because markets close and open and something may happen. And in cases like this, we'll have an overestimation. So what we did is we erased 30 minutes of the starting and ending part of the data set. So we'll end up 10 days, 1 hour less per day. We'll end up with 50 hours of data, and we'll fit the same a standard deviation of optimal leverage as predicted by the blue line is the prediction of the ergodicity economics, and the points is what we actually see in the data. And we can see that this overestimation gets a little bit better for shorter time scales. Now let's go to the average of those optimal leverage. We'll see it's pretty stable around the middle. This is stochastic market efficiency. It's an attractive point. The optimal leverage is an attractive point, and hopefully close to 1. We'll see the lower the time scales, we'll see that the more fluctuations we have, and even those fluctuations are explained by stability and not economic information, right? Economic information in terms of minutes and even milliseconds or seconds doesn't make sense. And actually, classic economic theory doesn't have a prediction for optimal leverage. We already said that the prediction of classic economic theory is that everyone should look for their own better optimal leverage, and not that there is an optimal leverage for everyone. So basically, having this structure here says that classic economic theory is basically wrong. Like, it's not the case that everyone is like better off doing what they want. The case is that this has a structure in the market that's required by the stability of the market. Closing in a little bit more on this. Perfect. This is the same graph. The graph on the left hand is the same points, and we'll see how this structure appears in mostly all of the data that I have analyzed for Apple, Amazon, and Google. And it also appears in the time window of days that was done by Ole and Alex. And this is my reproduction of the results, basically. And we can see that in this case, we have higher volatility, basically. We have lower time windows. And we'll see like a high variation from 200 to 0 and going around 0 or 1. And in the case of the S&P 500, this is S&P 500, which is an index. It's different from only one stock in a company. We'll see that the evolution of the optimal leverage in terms of the time windows goes closer and closer to 1 the longer the time you wait, basically. So this is the end, basically. Some final remarks is that the optimal leverage and the fluctuations are predicted by the Ergodicity Economics project. They hold remarkably well, even for short time scales. So we had before weeks to decades, now we have minutes to hours, basically. So we extended this range of applicability. Also, this is important, the average optimal leverage per time window is also stable and presents a structure as predicted by the stochastic market efficiency argument, which is important also because classical theory, again, doesn't have any prediction about optimal leverage. It says it can be whatever thing like people want it to be, which is clearly not the case. And well, this also supports the new theory of noise. Noise is due to stability, basically. The shorter the time scales you go, the more volatility there will be, and this cannot be explained by economic information. Basically, these are all ad hoc things you will add to classic models to not rule them out and go with the time average growth rate. And yeah, this is a general sentence, which is the leverage efficiency is a fundamental organizing principle for the stochastic properties of markets, and the data analysis in the study is an empirical test successful for this fundamental principle. So thank you very much for listening, and that's
thank you very much.
My talk.
Questions? I can see it in your face.
I'm just thinking about
you want to ask something?
Yeah, just if you go back a few slides, you had an option that that one exactly. Up, yeah.
Mm-hmm.
What exactly is plotted here? Is this the absolute average?
This is the mean, the average optimal leverage with respect to time window. So this as the same as the standard deviation. These are averages of 1,000 points. These are averages of 10 points, because we have 6 hours.
No absolute value in this? Why is it all
No.
positive? I mean, there should there will be okay, there's a positive, there's a drift.
Yeah, I don't know.
Interesting. Do you have
All of those,
shape of this curve?
I have no idea.
Here, why it looks like this?
No, I mean, in terms of the same thing that we do for the standard deviation, we could do for the mean of the optimal leverage, but that might be the case that it should be from that perspective. This should be random. It should have more standard deviation. So this explains basically this shape, but it doesn't explain why they're all positive, basically. Maybe they're all positive because it's.
So there's a drift term.
Yeah.
Positive. I'm just curious. Okay.
Yeah.
Interesting. This can probably be predicted.
Yeah. Yes. I was thinking of that, but.
How does the distribution look like on the optimal leverage? Is the same, right? Is the parabola, right?
Yeah, the parabola. Yeah, this is not a parabola, but
No, I mean, for example, you take one time.
Yes.
What is the distribution?
Yes, it's a parabola. Yes, everything is a parabola. Time average growth, like that means the geometric Brownian motion model is very good for this. Like, it's a parabola without telling it like you should be a parabola.
Ole.
It's just one remark. So this is it's an interesting thing. The geometric Brownian motion model has the Brownian motion in it, and that's the Gaussian, which gives you the parabola when you take the logarithm. So true. And we've seen the data that lined up wonderfully along this parabola. So in one sense, this model is amazing.
Yeah.
Because it really accurately predicts the shape of
Yeah.
this curve. But it's also absolutely horrendous as a model, because where that curve ends is where you go bankrupt.
Yeah.
At the end points, it actually goes to a minus infinity.
Yeah.
So within its realm of validity, it's a perfect model. Outside its realm of validity, it's a catastrophic model.
Yeah. Interesting.
More questions, comments, suggestions, complaints? No? So thank you very much. It was very interesting.
Thank you very much.